In the alternate version of problem 10-3, we're going to continue with Hillside with a slightly different bond issue of $2.7 million, 7% contract rate, 15-year period, dated January 1st, 2016, still paying semi-annual interest on June 30th and December 31st. This time the issue price is going to be $3,304,790. We're going to jump into recording the journal entry. We're going to debit cash for the amount received. That's going to be $3,304,790. But this is going to be a little bit different. We have a premium. They're receiving more than the par value or the maturity value that they have to pay at the end of the life of the loan. That's considered to be a premium. While a discount was a contra liability account, the premium is an adjunct liability account. Don't worry, not too scary. That means it's related to bonds payable, but instead of subtracting from it, it adds to it. So it has the normal credit balance, so we increase it with a credit. The dollar amount is the amount of cash received, $3,304,790, minus $2.7 million of par value, or what they have to pay at the maturity, is going to be a credit of $604,790. Total amount of the premium is $604,790. We're going to credit bonds payable for a par value. That's ultimately the amount they have to pay at maturity for $2.7 million. Again, I pointed out this was a premium situation. I can't tell you from the information we have here, but the exact value, but I can at least say the market value would be something less than the contract rate of 7%. So it might be 5%, 3%, whatever it might be, but it's less than. How I came up with that is it's being issued at a premium. Think about that. If other similar bonds are maybe only paying 5% interest, but Hillside is willing to pay 7%. That's an incentive to potential bondholders, right? They can get 7% from Hillside, but only maybe 5% from other people. So they're willing to pay a little bit more up front in order to get that additional interest payment over the life of the bond. So it makes sense why it was issued at a premium. Similar to our last problem, let's figure out the semi-annual amount that they pay in interest cost, and also the amount of straight line amortization, but this time it's amortization of the premium, and the total interest cost each semi-annual period. Let's move forward with just calculating the cash payment. Take the par value of $2.7 million times our semi-annual contract rate. This time it's going to be 3.5%. Annual rate of 7% because of the fact that we're paying interest twice a year. Take the annual rate of 7% divided by the number of times per year, 2, is going to give us 3.5%. 3.5% times $2.7 million in par value gives us a semi-annual cash interest payment every 6 months of $94,500. That's the actual amount of cash that they're going to pay. Keep in mind, we also have to amortize our premium, just very similar to how we amortize our discount. We're going to use straight line. The total amount of the premium was $604,790, just the difference between the amount of cash received and the par value. We're going to evenly record that and amortize that over each of the periods. Our total semi-annual periods is 30. 15 years times 2 periods per year equal a total of 30 periods. So $604,790 divided by 30 means straight line premium amortization each semi-annual period is going to be $20,160. So very similar to how we did straight line depreciation. We just divide it by the number of periods to get an even amount. This is where things are going to change a little bit compared to the discount. When we were in a discount situation, the discount amortization added to the total cash payment to increase interest expense because in a discount they were receiving less up front. In a premium situation, we subtract the premium from the cash payment in order to arrive at total interest expense each semi-annual period or total interest cost. Think about it. They're getting more up front than they have to pay at maturity. So really that lowers the cost of this particular bond over the life. So let's take our semi-annual cash payment of $94,500, subtract $20,160 as our premium amortization, meaning each semi-annual period, the true interest expense or interest cost is $74,340. So let's attack total interest cost or expense over the life of the bond a little bit different way. Let's first look at how much Hillside pays over the life of this particular bond. 30 payments of $94,500 equals total interest paid of $2,835,000. They're paying par value at maturity. At the end of the life of the bond, they've got to pay $2.7 million. So $2.7 million plus $2,835,000 in interest payments means they pay a total cash over the life of the bond of $5,535,000. Subtract out the amount they received up front or borrowed, which is $3,304,790, meaning the total cost or interest recognized over 15 years is going to be $2,230,210. Think about this. This is less than the amount of interest actually paid. Interest expense is less than the amount of interest actually paid. But consider again, they received more up front than the actual par value, so that lessens the amount of cost over the life of the bond. So let's continue moving forward with starting to prepare our amortization table. We have an unamortized premium at day 1, January 1st, 2016 of $604,790. Therefore, our carrying value is $3,304,790. How did I come up with that? I simply took our original par value of $2,700,000 and added to it our premium of $604,790. Remember, premiums add to, it's an adjunct liability, it adds to bonds payable, so it's going to increase the carrying value. It's a little tricky because our discount reduced our carrying value, our premium is going to increase it. Every single period, we're going to equally amortize $20,160. So as of June 30th, 2016, we are going to bring our premium from $604,790 down to $584,630 by subtracting out an amortized premium of $20,160. We bring down our carrying value to $3,284,630. Again, this might seem counterintuitive because it seems kind of tricky compared to what you did with the discount. But keep in mind, our premium adds to carrying value. So if we have a lesser amount of premium, our carrying value is actually going to decline. As of the end of December, I'm going to subtract out another $20,160 that we amortize, bringing our unamortized premium down to $564,470. Again, our carrying value, recalculating it, it's bringing it down again a little bit more by $20,160 down to $3,264,470. Eventually, at the end of the 15 years, very last period, our carrying value declines down to $2,700,000. Again, an unamortized premium is going to decline over time as we take a little bit of a chunk away. The premium adds to our bonds payable in order to calculate carrying value, and over time our carrying value declines down to par value. So last and not least is we'll prepare a journal entry for the interest payments. Our homework problem asks us to do the first 2 interest payments. I'm just going to save a little time and do the first one. The true answer is that they're all the same over. So we have 30 interest payments that we record the journal entry the exact same way. So our total bond interest expense that we already identified in step 2, so I'm not going to go back and calculate it, is $74,340. We debit an expense account to increase it, so we'll debit bond interest expense by $74,340. In step 2, we also identified that each cash payment is going to be $94,500, so we'll credit cash for $94,500. Also, in step 2, we identified that the amount of premium we're going to amortize each individual period is going to be $20,160. Remember, premium on bonds payable is an adjunct liability account. It has a normal credit balance, so we would reduce it by debiting premium on bonds payable for $20,160. That rounds out a balance journal entry, and again, that's the same journal entry that will record for all 30 periods where we record an interest payment.